Hey everyone, and welcome back to Alpha Finance. Today I want to talk about the short squeeze on GameStop stock. I'll start off by talking about what a short squeeze is and giving some examples of it, and then applying how that affects GameStop stock in this situation. Then I'll discuss what this means for investors, how to deal with it, and the dangers to look out for on a short squeeze such as this. If any of this sounds interesting to you, make sure to subscribe because I make content like this all the time. My goal here at Alpha Finance is to provide short and educational videos for you investors out there who don't have the time to be scouring the stock market and news all the time. Remember to do your own due diligence before making any investment decisions and to consider your own unique financial situation. Anyway, let's dive right into it. I'll start off by examining what a short squeeze is and looking at some examples of it in the past. Then I'll be able to relate that more so to what's happening nowadays with GameStop. To understand what a short squeeze is, you first need to understand what shorting a stock is, which I'm sure most of you do anyway. Quick TLDR of it is, you borrow a stock from your broker with some fee, you sell that stock to the market, you wait for the stock to fall if that's what you think what's going to happen, and then you buy back the stock later on and give it back to your broker. And if the stock has fallen over that period, you make a profit of the difference in the price that you sold it for originally and bought it back for. Or if the stock price goes up, you make a loss. On top of this, you also usually pay a fee to your broker, which gets higher depending on how long the short position is open for. So a short squeeze typically plays out in the following way. First, there will be a large number of investors shorting a stock, as I'd explained before how shorting works, as a proportion of the stock's total float. Then something will happen in the stock, say some positive news, where the overall sentiment of the stock goes up, so people start buying it. So what can happen and what turns into a short squeeze is as this price goes up, if it is going up to a large degree, people who had previously shorted the stock will cover their positions, and to do that they have to buy the stock. So that acts almost as a domino effect, with more and more shorters turning over to the buy side to cover their positions, only increasing the demand for that stock even higher, causing the stock to rocket. So in turn what this does is it creates a form of vicious cycle where the higher the stock price goes, the more margin calls that happen to short sellers, and the more of them end up having to cover their position and buy the stock, only making the stock go even higher. I think the best way to explain it really is to use an example, so I'll look at the Volkswagen short squeeze that happened back in 2008, which is probably known as the most famous example of a short squeeze. So there was short interest in Volkswagen initially because during the great financial crisis back in 2008, it had been viewed as a high probability bankruptcy candidate. And this was partially due to the fact that the entire automotive industry as a whole had seen a downturn. There was obviously debt crises peaking, and Volkswagen in particular had very high levels of debt. So due to these reasons, there was institutional investors who were shorting this stock, and that came out to about 13% of the stock's total float, which were shares that had been shorted. So prior to the short squeeze, approximately 55% of the shares of Volkswagen were held by insiders, so those aren't liquid to begin with. And then what caused the short squeeze is essentially overnight, Porsche announced that they had acquired an additional 44% of the leftover shares, meaning only 1% of shares left in the market were frequently being traded as liquid shares. So whereas previously approximately 45% of the shares were rather liquid, now only 1% of the shares were liquid, with people buying and selling them often. So this means essentially overnight, short interest in the stock on available shares essentially went from a third to 13 times the amount of available shares. So for every stock that was available and being traded in a liquid market, there were 13 shorters who were trying to buy back that share at a later date. So what this caused is it caused panic buying amongst the short sellers into trying to buy that leftover share in order to cover their short position. This caused the demand for those shares to absolutely rocket, which in turn drove the stock price of Volkswagen to go from approximately 210 euros to over 1,000 euros in the course of 2 days, making it the single most valuable company in the world for a very short period of time, even though it was going through crisis and had almost gone bankrupt. This rise in price is purely based on the short squeeze and not based on any fundamentals of the stock, so after the short squeeze it immediately comes crashing down right back to its fundamental value. So now we have an idea of what a short squeeze is and why it takes place. Let's apply this to what's happening with GameStop today. So GameStop hadn't been performing well over the last couple of years, and a lot of that is due to the digitization of games, people moving online and getting away from brick and mortar retailers like GameStop. And due to these factors, investors started to build up quite substantial short positions on the company, amounting to about 140% of total shares. The reason this is over 100% is because some shares can be borrowed more than once using leverage. Due in part to high short interest in the stock, contrarian investor Michael Burry actually bought into this stock back in mid-2019. You're probably thinking, Michael Burry? That sounds familiar. And that's because he's from that movie with Michael from The Office and Captain America. He's the character played by Christian Bale who shorts the housing market. Wait, no, not him. Nope, wrong character. Wrong. No. Okay, there we go. You might recognize him now. Burry bet big on GameStop, believing it would recover in price, expecting demand to rise on next-gen console sales. In particular, he cited the fact that these new additions would have disk drives, whereas many investors previously thought they would not. As he's known for being the guy who figured out that the housing market was going to collapse and therefore did, quote, the big short, he's a typical contrarian investor. That's why he invested in this company that has so many short sellers against it, part in which because he suspected a short squeeze in the future, which is now what's happening. So now that we have that out of the way, what on earth has been going on with GameStop in the last couple months? Back in April, it bottomed out at about $2.80 a share. As of this weekend, it sits at over $60 a share, having peaked at over $70 a share on the trading session on Friday. So what led to this massive jump in price? The first major factor is the release of the PlayStation 5 and the new Xbox Series. The second major reason is that Ryan Cohen, a major activist investor best known for Chewy.com, has recently joined the board and is looking to change the company in many positive ways. These two factors are likely what caused the share price to increase from the bottom up to about $20. The rest of the increase in value though, from about $20 up to where it is today, and even what we might see beyond this price, is due to the short squeeze. So what can we expect to happen with this short squeeze? The heights to which this short squeeze can go basically comes down to how long investors, such as the guys on Wall Street Bets and the other institutional investors like Ryan Cohen, are willing to hold and not sell to the short sellers. If this is the case, we may see the domino effect continue and it could push higher and higher. It all comes down to how many liquid shares are in the market that these short sellers are able to buy. If there are very few people willing to sell, we could easily see the stock price go much higher. However, one thing to be very wary of is this can all unravel very, very quickly. As soon as people start selling their stocks, the short squeeze will end and the market price will come crashing down to a level that more fundamentally matches what GameStop is worth. Typically, short squeezes happen over a very short period of time, so I would not be surprised at all come midweek next week, the short squeeze already to be over and GameStop price to have crashed right down to about $20 again. However, in the shorter term, in the next couple of days, it would not surprise me at all if we see GameStop's stock absolutely soaring. It's very hard to put an actual number on how high it could go, and the main reason for this is that we don't have a clear picture of how many shares currently traded are very liquid and how many investors currently holding GameStop are willing to sell. Either way, I find this situation to be absolutely fascinating, and a short squeeze on this scale does not happen very often. Personally, since I like to invest in a more long-term style, I'm not going to be buying GameStop. However, I could see for people who prefer to trade on shorter periods that there's definitely some major gains that can be gotten from being in this stock right now. I really do want to emphasize the risks, however, that come with a short squeeze. You could buy in now, it might go up 50%, but by the end of the day, the squeeze might have collapsed and it could crash. Therefore, at least for this, I'll be sitting on the sidelines and just watching how it plays out as an interested spectator. If you've already gotten into GameStop, you're very lucky. I could see this going much higher, but make sure to be wary that this could come crashing down at any point, so have your stop orders ready to go. Anyway, thanks a lot for listening, and make sure to subscribe if you enjoyed the video. I'd just like to refer one more time that this is not financial advice, and you all need to consider your own financial position before investing. Especially in a situation like a short squeeze, where your investments can change by great amounts in a short amount of time and it's extremely volatile, you have to be very careful and consider your own risk profile. Anyway, if you enjoyed the video, subscribe and I'll see you next time.